Daniel was both excited and nervous on his first day as an intern in the accounting department at Novitech Ltd. As he walked in, he noticed the buzz of activity around the office. Desks were neatly arranged, and monitors glowed with spreadsheets and dashboards. Miss James greeted him with a warm smile. "Welcome, Daniel. This is the accounting department. We don't just crunch numbers here. We help the business stay informed and make smart decisions." Daniel nodded. "I always thought accounting was just about preparing reports." "That's part of it," she replied. "But we also help other departments by providing advice, tracking budgets, and making sure the company's finances are in order." She pointed to the large whiteboard showing the department's structure. "At the top, we have the finance director, Mr. Grant. He reports directly to the CEO and the board of directors. Then there's the treasurer who looks after cash flow and the company's funds. The financial controller manages the day-to-day accounting. Ravi, our management accountant, handles the cost and budget reports. You'll be assisting him this week." Daniel was introduced to Ravi, who handed him a folder. "This contains last month's budgets and actual figures. We compare these to help managers plan better. It's one of the ways we provide useful information, not just numbers." Later that day, Kara, a quiet woman with sharp eyes, introduced herself. "I'm from internal audit. We check to make sure the company's rules are being followed, and that errors or fraud don't go unnoticed." Daniel raised an eyebrow. "Like spies?" She laughed. "Not quite. We don't report to any one department. That helps us stay fair and independent. We even test if employees are following our company policies." Daniel saw a document titled Company Policy Manual on his desk. "That's where all the procedures are written down," Kara said, "like how to approve the purchase of a new computer or how to choose a supplier." Ms. James added, "Having rules helps us stay efficient and avoid mistakes. But we have to be flexible too. Rules should guide us, not trap us." Daniel spent the rest of the week assisting Ravi, reviewing documents, and even observing a mini audit with Kara. By Friday, he had a whole new appreciation for how accounting supported every corner of the business. This isn't just numbers, Daniel thought. This is the system that keeps the company steady.
Quick overview. Accounting function is part of the wider business system. It does not work alone. It records financial transactions, helps management plan and control, and complies with laws. Typical structure in large companies. Finance director at the top. Treasurer handles cash flow. Financial controller manages regular accounting tasks. Management accountant handles cost control and budgeting. The size, type, structure, and legal rules of the company affect how the accounting department is set up. Policies and procedures help maintain order and efficiency. They may be grouped in a manual, often stored digitally. Internal auditors work within the company, but independently. They ensure rules are followed and risks are reduced.
By his second week, Daniel was no longer shy about asking questions. After all, everyone in the accounting department had been kind and willing to explain things. On Monday morning, Ravi handed Daniel a report and said, "We're heading to the operations department in 10 minutes. You'll see how we help other teams." They entered a meeting room where a team from operations was already seated. Their manager, Miss Lopez, looked frustrated. "We've gone over budget again on packaging materials," she said, tapping her pen against the table. Ravi nodded. "That's why I've brought this budget report. It compares what you plan to spend versus what was actually spent." Daniel leaned in. noticing that the actual figures were much higher in May and June. Miss Lopez sighed. We had more customer returns than expected. That caused repackaging costs to rise. Ravi calmly explained. Now that we know the reason, we can adjust your budget for the next quarter. But we'll also need to monitor the return rate more closely. The more we understand, the better we can control costs. After the meeting, Daniel whispered, so accounting helps other departments plan ahead? Exactly, Ravi said. This is called management accounting. It's all about helping departments make good decisions. Later that week, Daniel found himself helping Ms. James prepare for a board meeting. She showed him a draft report. These are internal financial reports. The directors use them to make big decisions, like opening a new branch or launching a product. Daniel asked, how's that different from financial statements? Great question, she smiled. Financial statements are for outsiders like investors or tax authorities, but internal reports are just for people inside the company. They help us run things better. He nodded thoughtfully. So the accounting team helps with both daily tasks and big picture stuff. On Friday, Kara stopped by Daniel's desk again. We're doing a spot check on supplier payments. Want to come along? Daniel followed her and watched how she reviewed invoices and payment approvals. She wasn't just checking numbers, she was checking if people had followed the company's rules. I'm not here to catch people, Kara explained, but policies exist for a reason, like preventing fraud or double payments. Daniel asked, do we ever change the policies? Sure, she replied. Sometimes rules get outdated or slow things down. When that happens, we update them. We're here to support good work, not block it. By the end of the week, Daniel had learned something big. Accounting wasn't locked away in a corner of the business. It was at the heart of every smart move the company made. He smiled as he closed his notebook. There was so much more to accounting than he ever imagined, and he was just getting started.
Key concepts covered in Part 2. Accounting interacts with other departments to support planning and control. Management accounting helps internal teams make informed decisions. Internal financial reports are used by management, unlike financial statements for external use. Accounting supports both daily operations and strategic decisions. Internal audit checks if company procedures are followed and gives suggestions for improvement. Policies can change when needed, but they are essential for reducing risk.
Daniel had been at Novitec Limited for 3 weeks now. Each day brought new experiences, and he was finally feeling like a real part of the team. One morning, Miss James invited him into her office with a serious look on her face. Daniel, today I want to show you something important. It's about how we handle clients' money. Daniel tilted his head. Clients' money? Isn't all the money the company's? Not always, she replied. In some industries like banking, law, or even accounting, we sometimes hold money that belongs to our clients. That money must be treated very carefully. She pulled up a chart on her screen, showing 2 sets of accounts, one for Novitec and one labeled client funds. These must always be separate, she explained. If something ever happened to the company, we must make sure the client's money is protected. Daniel nodded slowly. So we can't mix it with the company's money? Exactly. That would be very risky and even illegal. There are strict rules about it. Later that day, Kara from Internal Audit stopped by with a folder. We're doing our monthly check on the client money accounts, she told Daniel. Want to come along? He followed her to a quiet office where a finance assistant was reviewing bank statements. Kara pointed to the files. These accounts are monitored closely. We make sure they match exactly and that there's no sign of unusual activity. Daniel asked, "What do you mean by unusual?" Kara replied, "We're also watching for signs of money laundering. That's when someone tries to hide illegal money by making it seem legitimate. We're legally required to report anything suspicious." Daniel blinked. "People really do that all the time," Kara said. "That's why we have to stay alert." She explained that in the UK, the Financial Conduct Authority, or FCA, creates the rules for companies like theirs. Every country has its own regulator, and businesses must follow the laws set by them. Back in the accounting department, Ravi showed Daniel how they keep client transactions separate from normal business operations. "We do this so we never lose track," Ravi explained. "Even one mistake with a client's money can be a serious problem." Daniel realized that holding someone else's money was a big responsibility. It wasn't just about numbers, it was about trust. At the end of the day, he wrote in his notebook, "Accounting means being careful with every penny, especially when it belongs to someone else."
Quick overview: handling clients' money. In some businesses like banks, lawyers, accountants, and fund managers, money is held on behalf of clients. Clients' money must be kept separate from the business's own money. This protects the client in case the business goes bankrupt. Industry regulators, such as the Financial Conduct Authority (FCA) in the UK, make rules to protect client funds. Money laundering is when illegal money is passed through a business to make it seem legal. The accounting department monitors client money and must report any suspicious activity.
The weeks passed quickly, and Daniel was no longer the nervous intern who had walked into Novatech on his first day. He had grown more confident, especially after learning how to handle client money and the responsibilities that came with it. But now it was time to go deeper. Miss James called him into her office. "Today," she said, "you'll be learning how we measure success." Daniel raised his eyebrows. "Like profits? That's one way. But success can be measured in many ways, especially across departments. This is called performance management." Miss James brought Daniel into a meeting with the sales and operations managers. She handed everyone a set of printed charts. "Each department has targets," she explained to Daniel, "and it's our job in the finance team to help set those targets and monitor performance against them." She pointed to a colorful graph. "This shows how much revenue the sales team was expected to bring in each month. This line here shows what they actually achieved. So if they do worse than expected, we raise questions." Daniel asked, "Exactly. Or if they perform better, we might reward them or adjust future targets." Daniel then heard the term budget for the first time. "A budget," Ms. James explained, "is one of the most common tools we use. It is a financial plan that estimates income and expenses over a certain period. We compare the actual results with the budget to see how well departments are performing." Daniel thought for a moment. So finance isn't just about recording the past. It's also about helping the company move forward. Miss James smiled. "Now you're getting it." After lunch, Daniel shadowed Ravi in the accounting room. "You've been learning about internal performance," Ravi said. "Now let's talk about financial accounting, which is how we communicate with people outside the company." He handed Daniel a file and a screen with columns of numbers. "We start by recording every transaction the company makes," Ravi said. "That includes sales, purchases, payments, receipts, everything. We use something called the books of prime entry for this," he continued. "Each type of transaction has its own book. For example, Sales go in the sales day book. Then what? Daniel asked. Then we categorize and post those transactions into ledgers like folders for each type of account. Once we've done that, we use the information to prepare the company's financial statements. Daniel looked up. What kind of statements? The income statement shows how much profit or loss we made. The statement of financial position shows what we own and what we owe. And who reads these? Mainly external stakeholders, Ravi said. People like banks, suppliers, and tax authorities. They need to know how healthy the company is. Daniel realized that financial accounting was like a window into the company for the outside world. The next day, Mr. Khan from the compliance team stopped Daniel in the hallway. Have you heard of Companies House? He asked. Yes, a little, Daniel replied. In most countries, Mr. Khan explained, companies are required by law to keep proper accounting records and file financial statements with a government body. In the UK, that body is called Companies House. Why do we have to file them? Daniel asked. Mr. Khan gave a firm nod. Because companies get something called limited liability. This means if the company owes money, the owners are protected. They won't be personally responsible for paying off business debts. Daniel looked thoughtful. So in return, the company has to be transparent. Exactly. It's a fair exchange. If you want legal protection, you need to be open with your financial information. Mr. Khan handed Daniel a list of people who might want to inspect a company's financial statements. Lenders like banks, to check if the company can repay a loan. Suppliers who sell goods on credit, to see if the company can pay them back. Employees, to understand if their jobs are safe and if salary increases are possible. Tax authorities, to make sure the company is paying the right amount of tax. Local residents, especially if the company has factories or offices nearby. What about shareholders? Daniel asked. They already get sent the company's financial statements directly. Mr. Khan said, so they don't have to go to Companies House. Daniel nodded slowly. So the whole system is built on trust and responsibility. Yes, Mr. Khan said, and as future accountants, you help hold that system together.
Quick overview Part 4. Performance. The finance department helps set targets such as budgets and monitors actual performance across departments. This process is called performance management. Budgets are financial plans that compare expected income and expenses with what actually happened. Financial accounting involves recording transactions, posting to ledgers, and summarizing the results in financial statements. Financial accounting is mainly for external users, such as shareholders, banks, suppliers, tax authorities. The regulatory system. Most countries require companies to keep accounting records, file financial statements with a government body, for example Companies House in the UK. These statements are public because companies enjoy limited liability. People who might inspect financial statements include lenders, suppliers, employees, tax authorities, residents.
Daniel was getting used to the fast pace at Novatech, but one morning, he walked into the office to find Miss James looking very serious. Today, Daniel, she said, we're going to talk about something critical. Compliance. Sounds serious, Daniel replied. It is. Let's begin with businesses that are not companies. Daniel joined a training session with other junior staff. At the front, Mr. Khan was giving a presentation. Not every business is a company, he began. Some are unincorporated, like sole traders or partnerships. These types of businesses do not have to file financial statements with Companies House like companies do. Daniel raised his hand. So they don't have to follow any rules. They do follow rules, Mr. Khan answered. Just different ones. For example, if they are registered for sales tax like VAT, they must keep records of their sales and expenses. All taxpayers, even unincorporated ones, must keep records of their income to back up their tax returns. Some entities like charities must report to charity regulators, even if they are not companies. So even if you're a small business, you still need to be responsible, Daniel said. Exactly, Mr. Khan replied. Now let's talk about what it means to keep proper accounting records. Ms. James took over the session and handed Daniel a printed checklist. Proper accounting records must be complete. Every transaction should be recorded. Organized. There must be a system to code and classify transactions clearly. Verifiable. Auditors or tax officers should be able to trace the records back to things like invoices or receipts. Secure. Records must be stored safely. Many businesses now use digital storage, which is accepted by tax authorities. Retained. You must keep the records for the number of years your tax authority or regulator requires. That could be 5, 6, or even more years, depending on the country. Daniel looked up. So if someone randomly asks to check our records, they should be able to find everything easily? Exactly, Ms. James said. Transparency and organization are the heart of compliance. Later that afternoon, Daniel was helping Ravi enter sales data when a message popped up on the office chat. It was about a company being fined for failing to file accounts on time. What happens if a company breaks the rules? Daniel asked. Ravi replied with a sigh. Many things, and none of them are good. He explained each one carefully. Fines and penalties. Companies that do not keep proper records or file their statements late can be fined. If they continue to miss deadlines, they may be struck off the official register. That means the company is shut down by the government. Tax audits inaccurate or late tax returns can lead to investigations. If the tax authority finds problems, they might apply fines or penalties. Audit opinions. If a company's records are poor or misleading, the auditor may issue a qualified opinion. This tells users that the financial statements might not be fully trustworthy. Public oversight reviews. In the UK, bodies like the FIRC check a sample of companies each year. If the statements do not meet the standards, the company might be told to reissue them correctly. Criminal offense. If a company intentionally publishes false or misleading information, this becomes fraud. Directors may face jail time or criminal charges. Stock market consequences. If a listed company fails to publish its financial statements on time, the stock exchange can suspend trading. This means no one can buy or sell shares until the issue is fixed. Daniel took a deep breath. So failing to follow the rules doesn't just affect the business. It affects people's jobs, reputations, and maybe even their freedom. Exactly, Ravi said. That's why the finance team must get it right.
Quick overview. Part 5. Regulation of unincorporated entities. Even non-companies must follow certain rules. If they are VAT registered, they must keep records of sales and expenses. All taxpayers must record their income for tax return purposes. Charities may have to report to charity regulators. Proper accounting records. All transactions must be recorded. There should be a clear system for classifying and coding. Records must be verifiable, secure, and stored for the required number of years. Records can be stored digitally if allowed by tax authorities. Consequences of non-compliance. Fines for failing to keep records or file on time. Struck off the register if the failure continues. Audits and penalties from tax authorities. Qualified audit opinion if records are unreliable. Forced reissue of financial statements if regulators find mistakes. Criminal charges for fraud if false information is issued. Suspension from the stock market if deadlines are missed.
It had been a long week of learning for Daniel, but he felt more confident every day. Still, one question lingered in his mind. "Miss James," he asked one afternoon, "who decides how accountants should act and what rules they follow? I know there's company law, but what about everything else?" "That's a great question, Daniel," she said, smiling. "Let's dive into the world of accounting regulation." The next morning, the team gathered in the conference room. On the whiteboard was the phrase, "The accountancy profession is self-regulated, but with guidance from around the world." Miss James explained, "While laws set the basic rules for companies, a lot of the details come from the accounting profession itself. Bodies like ACA guide their members. These organizations are independent from the government, but they are still watched closely to make sure they protect the public interest. So it's like teachers watching over students, but the principal still checks in," Daniel said. "Exactly," Ms. James nodded. "Let me show you who the key players are. IAS International Accounting Standards Board." Ms. James pointed to a map of the world. "This organization creates international financial reporting standards IFRS, which are used in many countries. These standards explain exactly how to treat specific items in financial statements. For example, they give detailed guidance on when to record revenue." The IASB is a non-profit group with members from different accounting bodies and people who use financial statements. IFRS is used by all listed companies in the EU and many others worldwide. IFAC International Federation of Accountants. IFAC is another global group, Ms. James continued. It includes more than 170 national accounting bodies, like ACA. Its goal is to make sure all accountants around the world follow high professional standards. IFAC also issues a code of ethics and international standards on auditing. You'll hear more about those later down. Daniel noticed a question on the screen. What if a country doesn't use IFRS for all companies? Ms. James answered it right away. Some countries have their own national accounting standards for smaller or unlisted companies. In the UK, this is done by the Financial Reporting Council (FRC). But listed companies in the UK still use IFRS. So the FRC handles the others? Daniel asked. Yes, Ms. James replied. Each country decides how to regulate its businesses. Next, Ms. James introduced another important player. Companies listed on the stock market must follow special rules too. These rules come from the stock exchanges themselves. For example, in the United States, the Securities and Exchange Commission (SEC) sets reporting requirements for all companies listed on US markets. Daniel nodded slowly. That makes sense. Investors need honest information. There's one more layer of protection, Ms. James added. In some countries, there are public oversight boards. These groups keep an eye on how the accounting profession is working. Sometimes there are government agencies, and other times they are private bodies. Here are two examples. In the UK, the Financial Reporting Review Panel checks random financial statements to see if they follow the rules. In the US, the Public Company Accounting Oversight Board (PCAOB) oversees how audits are done for listed companies. It was created after a huge scandal involving a company called Enron. Daniel looked up. So it's like layers of security. First the accountants, then their bodies, then government or independent checks. Exactly, Ms. James said. That's how the public can trust the numbers they see.
Quick overview, Part 6. Who guides the accountancy profession? Accountancy bodies like ACCA help set rules and oversee their members. These bodies are independent but still watched by government or public bodies. Key global organizations. IASB issues IFRS standards used by listed companies in many countries. IFAC sets ethics and auditing standards through its global membership. National standards. Local bodies like the FRC in the UK issue national standards for companies not using IFRS. Stock exchanges. Each stock market has rules. In the US, this is managed by the SEC. Oversight boards. Financial Reporting Review Panel, UK checks financial statements randomly. CABE, US oversees audits for listed companies.
The following week, Daniel returned to the finance office with a curious look on his face. "Miss James," he began, "I understand the rules and the groups that make them, but how do accountants know what is right and wrong? Is there something like a code they follow?" Miss James smiled warmly. "You are thinking like a true accountant, Daniel. Yes, there is a set of ethical principles that guide all accountants. These help them make the right decisions even when the rules are not clear. Accounting is not just about numbers," Ms. James explained. "It is about trust. Businesses, investors, and the public need to believe the information they receive is honest and fair. That is why ethics are very important." She wrote on the board, "Ethics equals doing the right thing even when no one is watching." Daniel nodded. "So ethics help keep the profession honest?" "Exactly," she said. "The 4 key ethical principles accountants follow. Integrity. This means being straightforward and honest in all professional work. Accountants should not cheat, lie, or hide information. Objectivity. Accountants must not let personal feelings, relationships, or pressures affect their judgment. They should be fair and impartial. Professional competence and due care. This means always doing a good job, keeping skills up to date, and taking care to avoid mistakes or negligence. Confidentiality. Accountants should keep information about their clients or employers private unless they have permission to share it." Miss James paused and asked, "What do you think might happen if an accountant breaks these rules?" Daniel thought for a moment. "People might lose trust in the company, investors could lose money, and the accountant could get in trouble." "Exactly," Ms. James agreed. "And sometimes the consequences can be very serious." Ms. James gave an example. "Imagine you discover a mistake in the company's financial report. That makes the profits look higher than they really are. What should you do?" Daniel answered quickly, "Tell the right people and fix it." "That is right," said Ms. James. "An ethical accountant must report errors, even if it might cause problems. Honesty is always the best policy." Daniel left the office that day feeling proud. He understood that being an accountant was more than numbers. It was about character and doing the right thing, even when no one was watching.
Quick overview, Part 7. Accounting is built on trust, so ethics are very important. Accountants follow 4 main ethical principles. Integrity, be honest and truthful. Objectivity, stay fair and avoid bias. Professional competence and due care, do your best and keep learning. Confidentiality, protect private information. Breaking ethical rules can damage trust and cause serious problems. Ethical accountants always report mistakes or dishonest acts.
A few days later, Daniel came into the office with a question on his mind. "Miss James," he said, "I hear people talk about financial statements all the time. But what exactly are they? What do they tell us?" Miss James nodded and said, "Great question, Daniel. Financial statements are reports that companies prepare to show how well they are doing and what they own or owe. These reports are mainly for the shareholders, but many other people like investors, banks, and employees also look at them. Let me tell you about the three main reports," Ms. James continued. Statement of profit and loss. This report shows how much money the company earned and spent over a certain time. It is sometimes called the income statement or profit and loss account. It helps people understand if the company made a profit or a loss during that period. Statement of financial position. This one is like a snapshot taken at a single point in time. It lists what the company owns, called assets, and what it owes, called liabilities. The difference between assets and liabilities is the owner's equity or net assets. This report shows the financial health of the company. Statement of cash flows, unlike the profit and loss report, which can include things like costs that do not involve cash right away. The cash flow statement shows the actual cash coming in and going out during the period. It helps us see if the company has enough cash to pay its bills. Miss James wrote on the board, "Profit and loss. Revenue minus costs equals profit or loss. Financial position. Assets minus liabilities equals net assets or equity. Cash flows. Shows real cash movements." Daniel asked, "Why is it important to know the difference between profit and cash?" Miss James smiled. "Good question. A company might show a profit because of sales made on credit, but if it does not collect the cash, it could struggle to pay its bills. That is why cash flow is very important. Some companies also create extra reports," she added. "For example, sustainability reports show how the company is helping the environment or society. Integrated reports combine financial and non-financial information to give a fuller picture." Daniel thought for a moment. "So financial statements tell a story about the company's money?" "Yes, they tell a story," Ms. James said. "But just like any story, you have to understand how to read it carefully."
Quick overview. Part 8. Financial statements are reports mainly for shareholders, but also for other interested groups. The three main reports are: Statement of profit and loss, shows profit or loss for a period. Statement of financial position, shows assets, liabilities, and equity at a point in time. Statement of cash flows, shows actual cash received and paid during the period. Profit and cash are different but both important. Companies may also prepare other reports like sustainability or integrated reports.